So when asset prices are soaring to historical highs, many people are asking, are we in a bubble? So what's your answer to that?
Normally a bubble is something which is financed by a lot of debt and quite often pops when there's a tightening of interest rates so that there's debt service payments and you have the adjustment. This is a bubble. This is a different sort of thing. This is something in which there's a vast amount of money and credit available.
So what would be your most important investment tips for investors now?
To not be in cash. I've been quoted by a lot that cash is trash.
And if dollar loses reserve status, which currencies will replace it?
I think we're entering an era in which different currencies will be competing with each other. And what is a currency? And so then that, and there'll be many currencies to choose from. This is a challenge for policymakers.
Do you still think the world is underweight Chinese stocks and bonds?
If you look at almost any measurement of what is the size of the capital markets, what's the size of the economy, what is good portfolio diversification, and so on, what is the attractiveness of Chinese assets and the like, the world is underweighted to a significant extent also.
We are joined now by Bridgewater Associates founder, Ray Dalio. It's great to see you virtually, Mr. Dalio. Welcome.
Thank you. It's good to be here.
In the next half hour, we would like to discuss one of your most popular works in China, Principles for Navigating Big Debt Crisis, and see how we could use your unique template to analyze the current situation. While the Federal Reserve on Wednesday said it will accelerate the reduction of its monthly bond purchases and signal 3 interest rate increases in 2022. So what's your comment on that? Do you think the US is facing an overheated economy and runaway inflation now?
What the Federal Reserve is doing is the obvious thing that I've just described that happens in all cycles. And so that's what you're seeing. Nothing should be particularly surprising about that. It's feeling the inflation and the faster growth rate. So you can judge that by indicators, not only the inflation rate indicator, but you can look at how much slack is in the economy. Where is the unemployment rate? Is there a lot of ability to hire people, or are you running low on that? Or where are the operating rates? Are the businesses operating in an overheated way because demand is pressing up against the capacity to produce? Yes, that's happening. But we also have another issue that's an issue to be concerned about. And that is the desirability of holding bonds and deposits. There's 2 types of inflation. There is cyclical inflation, which is the sort I just touched on, which means when the demand is pressing up against the supply, that makes higher prices to ration the demand. That's the normal cyclical inflation measured by unemployment rates and operating rates. There is also monetary inflation. Monetary inflation is the creation of money and credit, and it's dependent on the supply and the demand for bonds. I gave you the example before of the Federal Reserve buying the bonds, but because interest rates are so low, in other words, they're negative in real terms, they're negative, they're below the inflation rates, and they're below the growth rates. That's true for bonds, and it's even more true for cash. Because that's the case, it is pretty undesirable to own those. And should you get selling of those, that would make the situation worse. Selling of those would mean that not only does that it would mean that interest rates would have to rise faster than ordinary, or that the central bank would have to come in there and purchase, make the money, print the money, and make the purchases of those financial assets to hold the rate down. And so if that was to happen, that would be more inflationary. So there's some risk of that happening. We have to wait and see, but there's some risk of that happening too. If that was happening, that would be a very serious situation. It's serious nonetheless because of inflation, and that trade-off is a difficult trade-off. But if we were to see that dynamic, it would be even more concerning.
So how many times are you expecting the Fed to raise interest rates in the next year?
I expect that they will raise interest rates until that and beyond that having a negative effect on the equity market. When I look at the differences between the equity yield and the interest rates, in other words, the yield of stocks in relationship to the yield of bonds, and I look at what short-term rates are in relationship to long-term rates, I think that they can probably raise interest rates in the vicinity of 4 or 5 times before that stops. The pace at which they will do that will be politically sensitive. We're now in a political year. So November is an election. So over the next year, I think that there'll be a sensitivity to make sure that their rates are not raised so much so quickly that it would be disruptive. So I would expect in the early period of that to be a relatively slow rise in rates, then followed, and therefore probably also more inflation pressures, and followed by a more difficult trade-off in the year beyond.
Okay. So when asset prices are soaring to historical highs, many people are asking, are we in a bubble? So what's your answer to that? And if you think we're in a bubble, how soon are you expecting the bubble to pop?
It depends what one defines as a bubble. Normally, a bubble is something which is financed by a lot of debt and quite often pops when there's a tightening of interest rates so that there's debt service payments and you have the adjustment. This is a bubble. This is a different sort of thing. This is something in which there's a vast amount of money and credit available. And when you look at the price of equities in relation to the price, the yields of bonds, you see that all investments compete with each other. So cash, bonds, and stocks all compete with each other. And so while the multiples are high, the multiples of everything are high, and there's a lot of cash around. So think of it as this way. If you look at the stock market multiple and you say, well, it's, you could pick your numbers, but you say, let's use 35 times earnings. And you say, okay, what is the bond market multiple? In other words, that's about 65 times earnings. And stocks grow and bonds don't grow. And so are stocks expensive in relationship to bonds? No, they're not. So, is this a bubble produced by a lot of debt? No, it's produced by a lot of monetary stimulation, a lot of monetary money going out there. So that what you have is more of a flooding than you have a classic bubble that pops in the normal way.
So what would be your most important investment tips for investors now?
To not be in cash. I've been quoted by a lot that cash is trash. But again, it depends on the country. I should say we're talking about the United States. We're talking about Europe and so on. In other words, look at real returns. Look at inflation-adjusted returns. A lot of investors think that they are safe in cash, in other words, short-term deposits, because they don't move much. But the truth is that they lose money, most assuredly, to inflation. And so people have to look at what is their return in relation to inflation, because inflation is their buying power. So you always have to look at that. And so when you look at short-term interest rates, or even interest rates in general in the United States, they are not good in compensating for inflation. So number one is being there. That's if you're in the United States. The circumstances are much less true in China now, because in China is still largely in monetary policy one. They have not gone to still interest rates and triple R reserve requirements and all of those other means have not yet gotten to the point where there's been a hitting of zero interest rates and the necessity to do quantitative easing, which is monetary policy 2. And there's not been a move to monetary policy 3. So the picture in China is very different from the picture in the United States. And so when you're asking me the questions, I'm largely answering for the United States, but that doesn't mean that that's the same sort of picture in China.
You have warned that the dollar is at risk of losing its reserve currency status due to large amounts of money put into the system. So has the pandemic hastened the dollar's demise? And if dollar loses reserve status, which currencies will replace it?
First of all, I learned a lesson when I clerked on the floor of the New York Stock Exchange. I'll tell you the lesson that I learned. It was in 1971. And I was, as I say, clerking on the floor of the New York Stock Exchange, and I followed markets. And in that year, on August 15th, 1971, President Nixon got on the television and said that they defaulted on their obligation to pay gold for dollars. Back then, dollars were like checks in a checkbook. They didn't have any value, paper money, and they were claims to buy gold. And because the United States was spending too much money, and they were being turned in, the gold stock was going down, the gold supply was going down, and then they defaulted. And I went on the floor of the New York Stock Exchange the next morning, and I was expecting that the stock market, wow, there's a crisis, money as we know it was ending. And so I thought it would be a crisis and the markets would go down a lot. And I was exactly wrong. The stock market went up a lot. And what happened was, that was my first devaluation. I never experienced a currency devaluation. So I looked into history and I saw that the exact same thing happened on March 5th, 1933, with Roosevelt speaking on the radio and saying the exact same thing, which is you will no longer get your gold for your money. And what I learned about through that experience is that the printing of money, the creation of money like that, devalues money in relationship to many things. So when we think of money, we have to think about it devalues it in relationship to goods, services, and financial assets, such as stocks and other financial assets. It could be gold, but it could be other assets too. So when we have a devaluation, sometimes people think of a devaluation as being in relation to another currency. And what happens usually is that other currencies also devalue at the same time because they have their own circumstances. So that you see in other currencies, you are seeing that same type of devaluation. In other words, same type of printing of money and same type of devaluation. And when that does that, it causes those currencies to devalue also. So you don't see it much in relationship to the other currencies as much as you see it in relationship to goods, services, and financial assets. So to answer your question more broadly, I think we're entering an era in which different currencies will be competing with each other. And what is a currency? And so then that, and there'll be many currencies to choose from. This is a challenge for policymakers. There's a challenge for governments. Governments want to control the money. That's very important for them. It's a great power. It's a very important power in order to manage things well and keep order. But increasingly, there'll be more probably competition of those. So those competitions, sometimes there'll be all sorts of currencies competing. and there'll be all sorts of assets competing. Like I told you, stocks and other assets go up, commodities and so on. But it also can be other currencies, other nations' currencies that are fiat currencies, meaning not backed by anything other than the printing, or they can end up being digital currencies. All different currencies, and they're all going to probably be competing, and it's a delicate time because it's very important for governments to keep control of the currencies and this lever of supply demand so that they can affect the economy and manage it well.
Let's talk about China. Do you still think the world is underweight Chinese stocks and bonds? And would rising U.S. Rates put pressure on capital outflows from China and the renminbi exchange rate?
I think the world is definitely underweight assets. If you look at almost any measurement of what is the size of the capital markets, what's the size of the economy, what is good portfolio diversification, and so on, what is the attractiveness of Chinese assets and the like, the world is underweighted to a significant extent. Also, that's an extension of the United States having the world's reserve currencies and the world's financial center. I recently did a study, which will be put out as a book, called Principles for Dealing with the Changing World Order. And I went back and studied the rises and declines of currencies, particularly reserve currencies, over the last 500 years. I looked at the Dutch, the British, the American, and then China. And I studied the Chinese dynasties going back to the Tang dynasty. So a little after 600, I watched those types of patterns. And the patterns are very educational. And so in terms of a reserve currency, the cycle is, there are many parts of the cycle, but the cycle is that when a country becomes the world's largest trading country, and which the Dutch did, the British did, the Americans did, and China has. In other words, the most largest share of world trade. And it starts to trade and lend in its currency. That is more likely to become a world reserve currency. So the Dutch had the world's reserve currency during the Dutch Empire, and so for the British and the Americans and so on. The Chinese have not been active in a movement in that direction to internationalize the renminbi very much, but I would expect probably more of that. And then it's also the financial capital. The financial capital, Amsterdam was the world's financial capital in the Dutch Empire, but London was the world's financial capital in the British Empire. The New York was the world's financial capital in the American Empire. And it's logical that China will have a world financial center, and it's doing an excellent job of developing the capital markets and having them mature and developing liquidity, and also making them open to foreign investment. So for all of those reasons, yes, I believe that the world is underweighted in China investments.
Okay. I'm glad you mentioned your new book. I believe the book will be published in China soon, right? So let me ask, what will be the most important lessons from the book that we could apply to today's China-US rivalry? Let me put it another way. So what would be your suggestions to the US administration in terms of easing the tensions between the two countries?
Well, there are three things that pop as very big determinants to well-being. And there's a cycle. I go through the cycle. There's a world order. World order usually comes after a war. Then you know the winners and the losers, and then they sort of set the rules. And so in 1944, the world created the dollar Bretton Woods monetary system, and in 1945 we began the world order. The United States owned 80% of the world's money, which was gold at the time. They had 80% of the world's gold. It was half the world economy, and it was a dominant military power. And so we had the United Nations in New York, the World Bank and the IMF in Washington, and so on. That began the world order. And there's a cycle. And the cycle, I won't have time to describe all that cycle. But there are three things, in answer to your question, there are three things that make prosperity and the absence of war. Those three things are, first, are you spending more than you are earning? Do you have a good income statement and a balance sheet? Countries are in trouble when their granaries run down, and look at the empires, their granaries are down, and the coffers are empty. And so when I look at countries, one country or another, I pay attention to those things. And then there's a cycle of internal order and a cycle of internal order, disorder, and a cycle of external order and disorder. In other words, internal disorder or civil wars can lead to civil wars when there are large wealth gaps and large gaps. I have a principle that when the causes that people are behind are more important to them than the system is in jeopardy. And so I look at the level of internal conflict, and then I look at the level of external conflict between countries. And there are uncompromisable issues, and then there are compromisable issues. So what I think what everybody should do is read history and understand what conflict of war is like. There are 5 kinds of war. There is a trade war, a technology war, a geopolitical influence war, a capital war, and a military war. And when the first 4 of those are pretty much they're competitions, and the fifth is deadly. I think that it would be very, very important to people to understand history. There's a generation cycle. In my case, my father was in World War II and the Korea War. And that generation who went through the war and the hell of the war knows how terrible it is. Sometimes after that generation and a new generation comes up, there's more of an inclination to fight. I'm worried about that. So I think that by understanding history, I hope that my book helps to put some of these things in perspective, this upcoming book, because I think that if we all realize that we're on this planet together and that it is so important that the capacities to do unimaginably terrible things because technologies have developed that make war, those kinds of wars, intolerable. We have to be afraid of that, I think, or the capacities to work well together, to be able to do things in a way that if you can overcome those obstacles, that inclination to have a conflict, that the amazing things that can benefit mankind. So I think that has to be of paramount importance in everybody's thinking. In other words, the justifiable fear of war and the motivation of what can be done together. Let's look at the good and let's look at the bad and choose correctly, I think. So it's an issue really of getting along. In my case, I've been coming to China since 1984, and I've had the opportunity to get to know the Chinese people and the Chinese culture and to understand a lot. And I find myself in a position of being somewhat in the middle of this. And I think to some extent having understanding and an appreciation.
Thank you so much, Mr. Dalio. We are already running out of time. I want to thank you for this great discussion. Appreciate your insights and time. Thank you.
Thank you.